When Warren Buffett starts unloading billions in stock and cashing record cash reserves, you know something's up. Is the man known for his long-term vision of seeing storm clouds in the distance? Is the stock market crash around the corner? Recently, Buffett has made headlines by selling nearly $5 billion worth of Bank of America shares and halving his stake in Apple, two of his most significant holdings. But what's driving these decisions? Is Buffett bracing for a market meltdown, or is there a deeper strategy at play? In today's video, I'm critically breaking down Buffett's latest actions, examining the potential crisis he might be getting ready for, and in the end, I will show you how I would safeguard my own portfolio in this market. But first, let's look at Warren Buffett's recent portfolio moves. And it all starts with Bank of America stock. Over the course of a few weeks, Buffett decided to sell off a pretty significant chunk of his holdings, about $5 billion worth to be exact. That's roughly 13% of his stake in the company. So why would Buffett, who's been a rock-solid supporter of Bank of America since 2011, suddenly start selling his shares? It's a head-scratcher, right? Well, there are a few possible reasons for this move. First off, let's talk about valuation. Bank of America's stock has had a pretty sweet ride earlier this year, climbing a solid 31%. For someone like Buffett, who knows a good opportunity when he sees one, it might have been the perfect time to lock in some gains. After all, who wouldn't want to cash in when the getting's good? But there's more to it than just a well-timed sell-off. The broader economic environment is a bit shaky right now. We're seeing rising interest rates and some potential storm clouds gathering over the banking sector. So it wouldn't be too surprising if Buffett decided it was time to cut back on his exposure to these risks. Another angle to consider is portfolio diversification. As Berkshire Hathaway keeps getting bigger, managing concentration risk becomes a bigger challenge. By trimming his stake in Bank of America, Buffett might be freeing up some cash to jump on other opportunities, or just balance out his portfolio a bit more. Spreading the wealth around to keep things steady. Of course, the market didn't take Buffett's sales lightly. Bank of America stock took a 10% nosedive after the news broke, which shows just how much weight Buffett's decisions carry. And if selling Bank of America wasn't enough to get people talking, Buffett's decision to slash his Apple stake definitely did. Apple has been a cornerstone of Berkshire's portfolio for years, a massive bet on the tech giant's continued dominance. But the second quarter of 2024, Buffett sold nearly 50% of his Apple holdings, which is huge. We're talking about reducing his position by 389 million shares. So why would Buffett, who's reaped the rewards of Apple's meteoric rise, decide to sell now? One word: profit. Apple stock has delivered almost 800% returns since Buffett first jumped on board. Selling a chunk of that stake lets him lock in those gains, and let's be real, who wouldn't want to cash out with some of those winnings? Plus, there's been a lot of buzz about overvaluation in the tech sector. Companies like Apple have seen their stock prices skyrocket, and there's growing concern that we might be headed for a market correction. These moves suggest Buffett might be tweaking his strategy. He's famous for his buy-and-hold approach, especially with companies like Coca-Cola, where he's held his stake for decades. So the decision to pull back on both Bank of America and Apple could mean he's seeing limited upside in these markets moving forward. Or maybe he's just gearing up to be more flexible in what could be a bumpy market. In addition to the sales of Bank of America and Apple, he's also been trimming his positions in other companies like Snowflake and Chevron. It's like he's taking a more cautious stance across the board. And if you need more proof that Buffett's playing it safe, just look at Berkshire Hathaway's cash reserves. They're sitting at a record $189 billion in cash. Yeah, you heard that right. $189 billion. That's a pretty clear signal that Buffett is keeping his powder dry, ready to pounce when the time is right. So does that mean a stock market crash is coming? Let's answer the big question. For years, investors have looked to Buffett as some sort of market whisperer. So when he starts making bold moves, it's hard not to wonder if he's seeing something we don't. So let's break down the factors that could lead to a market downturn and whether Buffett's actions suggest that a crash could be looming. First up, let's talk about what's happening in the economy right now. We're dealing with a pretty tangled web of challenges that could set the stage for a market correction, or even a crash. One of the biggest concerns is rising interest rates. Central banks like the US Federal Reserve have been cranking up those rates to keep inflation in check. The idea is to cool down an economy that's running a little too hot. But the flip side is that higher rates also make borrowing more expensive. That can slow down economic growth and take a bite out of corporate profits. Now, think about companies that rely heavily on debt, like many in the banking sector. As interest rates rise, their costs rise too, squeezing profits and potentially dragging down stock prices. This could explain why Buffett's been trimming his position in Bank of America. He might be locking in gains before things get worse in the financial sector. Inflation is another issue we cannot ignore. Although it's easing in some areas, persistent inflation can still hurt consumer spending and corporate earnings. If inflation stays high, central banks might keep raising rates, increasing the risk of a recession. Buffett's growing cash reserves could be his hedge against these uncertainties. Cash is like a safety net. It holds value in short and offers the flexibility to seize opportunities when they arise. With US Treasury bills offering decent returns, holding cash right now isn't such a bad move. Let's talk about market valuations, a potential red flag. The stock market, especially tech, has been on a tear for the past decade. That's great for investors, but it's also raised concerns that some stocks might be overpriced. For example, the tech-heavy NASDAQ has companies with sky-high price-to-earnings ratios, which might not be sustainable. Buffett's decision to trim his stake in Apple, despite its strong performance, could reflect these concerns. Apple's valuation has soared, and while it's still highly profitable, these high multiples could make it vulnerable if the market cools off. We've already seen this before. It's like during the dot-com bubble in the late 90s. When valuations get too far ahead of reality, they tend to correct, sometimes painfully. While today's market isn't necessarily in bubble territory, the high valuations in tech and real estate could lead to a significant adjustment if the economy weakens. To understand if a market crash is coming, it's helpful to consider Buffett's historical approach. He's known for being cautious, especially when the market seems frothy or uncertain. This cautiousness has helped Berkshire Hathaway avoid major losses during downturns and seize opportunities when others were panicking. Take the 2008 financial crisis, for example. Before the crash, Buffett built up cash reserves and made selective investments, so when the crisis hit, Berkshire was ready to snap up distressed assets. Seeing Buffett sitting on $189 billion in cash right now might be a sign he's preparing for a similar scenario. But remember, Buffett doesn't try to time the market. His strategy is about being ready for anything. This long-term, value-oriented approach is designed to ensure that Berkshire can weather any storm and come out stronger. Before we start panicking, let's consider alternative interpretations of Buffett's actions. Maybe he's not predicting a crash, but simply repositioning Berkshire's portfolio to align with his long-term strategy. By reducing exposure to sectors that seem overheated or uncertain, like tech and banking, Buffett might be sticking to his principle of avoiding unnecessary risks. This helps keep his portfolio balanced and ready for different economic scenarios, rather than betting on one outcome. And sitting on all that cash might not just be about bracing for a downturn. It could also be about waiting for the right opportunities. Buffett's a patient investor, often holding cash until he finds something truly compelling. This might be one of those times when he's waiting for valuations to come back down to earth before making his next move. So, is the stock market crash on the horizon? The truth is, no one, not even Warren Buffett, knows for sure. I've covered some big warning signs: rising interest rates, inflation, and high valuations, but markets are complex and influenced by many unpredictable factors. Buffett's recent moves suggest he's taking a more defensive stance, but that doesn't mean a crash is imminent. It does mean it's a good time to be cautious, stay informed, and make sure your investments are diversified and resilient. You might be wondering, what should you do in today's market? Should you start selling off your stocks, hoard cash, or diversify into other assets? Let me break down some practical steps that I would take. First and foremost, diversification is key. I would start with the stocks that know how to weather the storms of market meltdown. When it comes to choosing resilient assets, I focus on dividend aristocrats and dividend kings, companies with a long history of paying and increasing dividends, 25 and 50 years of consecutive dividend growth to be exact. This time frame includes the market crashes of the 2000 dot-com bubble and the 2008 housing bubble, and they are still standing. In fact, they did better than any other stock out there. A good way to get exposure to these companies is through an ETF like NOBL, which targets dividend aristocrats. In addition to focusing on resilient assets, it's important to diversify across the entire market. For this, I recommend something like the Vanguard Total Stock Market Index Fund ETF, or VTI. This ETF gives you exposure to the entire US stock market, providing a balanced mix of large, medium, and small cap stocks across various sectors. For stable income, I would add real estate investment trusts like American Tower Corporation. REITs offer a way to invest in real estate without owning property and typically provide consistent dividends. American Tower is particularly appealing because it operates in the communications infrastructure sector, which is essential in our increasingly connected world. Finally, it's crucial to adopt a long-term perspective. Investing isn't about making quick profits. It's about building wealth over time. Avoid panic selling during market dips and resist chasing after the latest trendy stocks. Instead, focus on companies with strong fundamentals, competitive advantages, and a history of profitability. These are the businesses that can thrive over the long term, even during challenging economic periods. Want to know how I would invest $10,000 as a certified financial manager in this economy? Click the video on the screen to not only combat inflation, but to also turn that $10,000 into a portfolio worth over $300,000, all while staying on the safer side.